I think that what we've had is market expectations are still too positive. When we look back at since December, what's happened is the market has really rallied on the Fed pivot, on these kind of positive news about US-China, but fundamental economics has been almost ignored by the market. So if you look at the economic data, it's generally on a downtrend, and yet the market hasn't been responding. So that concerns me that there is a buildup of a potential move down once that market starts to really recognize what's going on.
Were you pleased with Jerome Powell's testimony yesterday, and what do you expect from him today?
It was pleasing in that it was the same message as previously. And obviously, in the last few months, the issue has been really the communication has been kind of flip-flopping both ways, which is what's really been unsettling markets. So the fact that Powell was very straightforward, similar message to what previously they're going to be patient, data-dependent, was a positive, and that's why there was minimal reaction from markets. Now, today, it's going to be difficult to say where this is going, but I suspect there'll be more conversations about the balance sheet and maybe further kind of pushing on the international global economics and where that's going.
We talked about this yesterday. The bond market, with a yield of 2.66% or whatever it is, seems to be telling us one story, but the stock market, with its best start to a year since 1987, seems to be telling us a different story. What story do you believe?
I actually think the bond market is telling you something, that they believe that growth is low. They're not too concerned about inflation, whereas equity markets has really been ignoring that. Now, at some point, once bond markets start to think that, okay, maybe inflation is starting to come through still, but the economics is weak, that's where you could have the equity market and bond market starting to meet in the middle with bond yields rising, equity markets starting to weaken. And I think that would be the worrying side.
So what's the advice for clients then for the rest of the year? Because there's many people on this show have said, the gains are all in.
Well, I think it's very important to remember, I don't think that there's going to be a recession this year or even into 2020. So without an economic recession, you should still be invested. There are places to be. Globally, I still believe that actually US equities have a little bit further to run.
A little bit.
A little bit.
Not a lot of it.
No, not a lot, because I do believe those economic numbers are going to start impacting the equity market at some point. But the emerging market side, I think, is positive. We are very, eager on the China side that there's going to be some stabilization there later this year. So that's working for EM Asia. Now, Europe, I know, is a tough story. But generally, within equities, you want to be in higher quality stuff, up in quality. And same thing with credit. If you're going to be in credit, be in the safer places, investment grade.
You know why Europe's a tough story? You live in London. We do not know if you are going to be a part of London or Europe going forward in about a month's time. How does Brexit factor into all this and your analysis? Does it make it almost impossible to run economic models when you don't know if the UK is going to be a member of the EU?
I think it's very difficult at the moment to invest in the UK, simply because, as you said, it's a very binary situation. If we leave, there's going to be a major economic impact. And if we stay, of course, we'd expect things to improve. Now, on the global side, it's very important for the European story. If we leave with no deal, I expect there to be a negative impact on Europe, on a European economy, which is already very weak and I think is in a difficult and slightly dangerous position. But on the global scale, if you're looking at the US, Asia, I actually still believe it's a very minimal impact from Brexit.
Yeah, I think the IMF and the World Bank would agree with your analysis there, Seema. So if we do see the UK leave, let's say there's no deal, the hard Brexit, if you will, 40% of our revenues on the S&P 500 come from overseas. Do we automatically then have to ratchet down U.S. earnings expectations?
Yeah, in no-deal Brexit, you're looking at, Bank of England forecast of a -8% dip in growth. That is pretty significant. So, of course, that is going to have an impact on the companies that operate in the UK, that have a lot of their sales in the UK. So there is that impact, and certainly the repercussions of such a very significant move would be, very, very noticeable. But I have to say, we still think that that's very, very low risk, especially from the news that we've been getting the last few days.
But you think Chinese equities may be a good buy here, if I heard you correctly?
I do. I think that the stabilization is going to come through. We've had something like 67 different stimulus measures since last June. Now, stimulus works with a lag. It doesn't happen overnight. Same thing with the US, exactly what you'd expect. They've also had to change a lot of their policy making because they've seen some of it is less effective than the others. When you have confidence as low as it has been, and you have tax cuts, unfortunately, it's not spent, it's just saved. So they've had to pivot towards more of the credit, the monetary easing measures. They've also ramped it up. So I expect that stabilization to come through. Do I think it's going to be a big boom like we saw in 2016? Absolutely not. They still have to deleverage. They're still at the top of their minds. So they don't want to have this huge leverage push with increasing debt. So stabilization is all it is. But that's enough. When you've got valuations looking as good as this, then you just need to have a stabilization.
Where else in the world is principal finding value?
Well, actually, I think it's in terms of assets. Firstly, you have to look at balance sheets. That's going to be the key thing going forward. It's not just about sectors or style. It has to be about strong balance sheets and wide profit margins. And on top of that, if we expect a slowdown but not a recession, and either way, even if you think interest rates are going to go higher, they're not going to get more than 1 or 2 more hikes. So in that situation, real assets, or really real estate, I think is going to be a great position.